I will just do a short introduction and then you can share the slides then, okay?
Yeah,
Okay.
I'll share them.
Yeah, we'll kick off now. So good morning, everyone, and welcome to Investor Ready, Understanding EIS for Business Growth. We're delighted to have you with us for this live and informative session with Quintus Capital. So if you're a business owner exploring ways to attract investors and scale your company, you're in the right place. Today's session will unpack the Employment and Investment Incentive Scheme. Whether you're new to EIS or looking to refine your funding strategy, you'll leave with valuable insights and practical guidance. So I do encourage everyone's participation throughout. You can ask questions through the Q&A or chat. So this event is hosted by Tom Francis, a head of accounting and small business at Knorr. So we're excited to be joined by two expert guests from Quintus Capital, Kevin Cannon, CEO and Investment Director of the EIS Innovation Fund, and Tim O'Callaghan, Investment Manager at Quintus Capital. So I'll just hand you over to yourselves just to do a short introduction and tell us a little bit more about Quintus Capital.
All right. Thanks, Joanne. So Quintus Capital is a private market investment firm. We're based in Cork. We have offices in Cork and Dublin. And I suppose we're best known for running a regulated EIIS fund. Now, EIIS investing has changed a lot over the last 20 years, 2 years, pick any time scale, it changes all the time. There's tax reliefs. Anything with tax reliefs or change would have taken a pen from revenue on an annual basis. So even our investment thesis changes from year to year, the types of companies we invest in, so we can get into that a little bit later. So I would just ask anyone who's on the call, I'm presuming people here are business owners who are looking to raise EIIS. So even if you do want to put in the types of industries you're involved in or kind of stage of your business into the chat, it could be helpful for us to kind of direct who we're talking to. So Tim, do you want to click on? So yeah, we're gonna keep it relatively short today anyway. It's about I think about 15-20 minute presentation, and then we'll try and do some Q&As with Tom and Joanne and for anyone who has questions. So first we're going to cover what is EIIS. EIIS is a tax relief. Tim, could you just click on to the next slide? So it is a tax relief for investors. So investors absolutely love EIIS if they're going to invest in your company. Main reason is revenue, giving them back money. So it can be up to about 18 months ago, it was relatively straightforward. You just got 40% tax relief if you made an EIIS investment. Then they changed it about 18 months ago. It's a little bit complicated now, but there's 3 different rates: 20%, 35%, and 50%. 50% is obviously really attractive to investors, but it's pre-revenue, so it's really, really early stage companies. We actually do quite a bit of investing in that space, but more in the social infrastructure space where there's maybe an asset involved, like a crash, and Tim can talk through a case study on that in a while. In terms of most business owners and looking to raise EIIS, you will fall within the 35% tax relief space. That is if you've made your first commercial sale and you're in your first 10 years of existence. So nearly all businesses would fall within that. Who's looking to raise capital? If you've gone beyond 10 years, you're probably into private equity firms or that kind of stuff anyway, or bank loans. So it's for earlier stage companies, but goes right up to 10 years, and even the 20% rate can go up to any age business. Just flick on to so in terms of amounts and stuff and how this works, the limits are quite high these days. Any company can raise 5.5 million in a 12-month period, or 16.5 million over the lifetime of their business. So we've looked at investments where you can do 11 million investment within a 13-month period. So you could actually, invest now in May, 5.5 million. You could come next May and invest another 5.5 million. So it's quite attractive. A lot of solar farms and stuff would use that, especially if something's been constructed and taking more than 12 months. It needs to, it needs to be a trading business. So anything that is a trading business kind of qualifies with a few exemptions. Well, any investor can claim up to €1 million of EIIS per year. That limit just keeps going up and up. 2 years ago it was only 250K. Last year it was 500K. This year it's 1 million. I'd imagine it's going to stay at 1 million. And look, there's very few investors who are caught by that cap. I'd love to say there's more investors who want to put in more than €1 million per annum into EIIS, but it's quite rare. In terms of the types of investments, most of the regulated EIIS funds, of which there's three of us probably. There was four. One stopped their fund this year. Um, you can do a redeemable equity or you can do ordinary equity. They're very different types of investments and they're for very different types of companies. Ordinary equity is just a normal share in a business. It's just there's no cap in the return, there's no exit period. You just buy a share of the business, revenue will give you back, say 35% of your investment. And the company takes the cash and you're along for the journey if it takes 8 to 10 years, whatever it is. Um, a redeemable share is very different, and this is how a lot of EWS funds operate. It is a defined period where the share needs to be redeemed back out. It's more like a loan than it is equity. So let's just say we invest €1 million into a business. We say this is a 4 year period. After 4 years, you need to redeem us out for, call it 1.25 million. Everyone kind of knows from the start that's it, and that's what you get. Now, the difference between the two is really to do with kind of the risk profile in the business. If you're more like a venture style business looking to scale, looking to, be high risk, go for broke kind of thing, you want ordinary equity or your investors will want ordinary equity. If you're more of a steady business that's maybe trying to open a few new locations or buy machinery to expand, the redeemable equity could be a good option, but it's for more steadier businesses that are lower risk, whereas the ordinary equity is high risk, high return kind of style investing. And what makes it really attractive to investors is, if an investor's putting in 100K, they might get 35K of it back. That means, it's only a 65K net cost to the investor. So they're a lot more likely to put money into your business. Should I go
Um,
to
Kevin, just that's very interesting. So there's kind of almost two options there. Like if you said you have your equity, which is just your, no I invest say 100K into a SME, subject to meeting the T's and C's, um, and I have to hold it for a certain period. I mean, I know we'll come to that, no doubt, during the webinar. But the other option then is it's almost like preference shares in a way. Is it like redeemable preference shares where I can get my money back, but at the same time get some tax relief as well?
There would, yeah,
Mm,
yeah. And look,
mm.
it's kind of trying to fit a system around revenue rules. So revenue rules say you need to hold your shares for a minimum of 4 years in the company to get your tax relief, or else there's a clawback. So, clever funds like ourselves, BDO, BVP, Baker Tilly, or Zets now, they've all basically work off this redeemable share. So our money needs to stay in for a minimum of 4 years, and then we try and get it back out. So it's sort of it's a different way of investing, but it's to try and make use of the tax relief and including the tax relief into sort of your return calculations. So like if I just compare, maybe if I was an ordinary equity investor, I'd say the average investor for an angel investor or investment period is probably 8 to 10 years. Um, so you might only get your tax relief at the start and then you don't get cashed out for 10 years. Whereas if you go with the redeemable option, you actually might get two tax reliefs in for the same capital within that 10-year period. So it can work out better, even though it's a lower return from the company.
Yeah, very interesting.
So yeah, that's this redeemable equity. So like again, this is I've kind of said it already, but this is like how our fund works. That's how a lot of the funds work. I think everyone besides Elkstone really. Elkstone's more of a VC fund that offers tax relief to investors. Um, so they're very much the ordinary kind of VC style. The rest of us are all more redeemable equity. We put in our cash. There's no payments to any investors for 4 years. In 4 years, you get redeemed out. The rate of return in the coupon very much depends on the risk profile and even how much tax relief you're giving. So if someone is getting 50% tax relief up front, they might be more amenable to take a lower return on the back end. Whereas if it's 35% tax relief, like when we're working out our returns, projected returns, it's all on IRR calculations over a period, including tax relief. So if there's higher tax relief, there could potentially be a lower coupon.
And that 50% tax relief, that's really for the early stage businesses, isn't it? More so than kind of an existing business that's already up and running.
It is,
Yeah.
and like when the revenue rules came out originally, we thought, okay, this is probably going to be great for a med tech business, or high R&D businesses that don't make their first sale for 5, 10, 8 years kind of thing. Um, and that's not really how we invest. It's probably too high risk return. Um, and then everyone sort of quickly figured out you can actually do larger scale infrastructure projects like solar farms, wind farms. You could, go build childcare facilities, healthcare facilities. All this kind of stuff also fits into it. So that's very much what kind of investments we look at now. We're doing a sports facility in the next few weeks as well. But buying a warehouse, converting it into paddle courts, plunge pools, saunas, hot yoga studios, this kind of stuff. Big open warehouse. Yeah, so there's loads of really cool things you can do with it. So there can be a real estate angle too, provided it's a legit trading business and you're not just buying an office block to lease it out.
Okay.
And the next slide, Tim.
Yeah, so thanks, Kevin. I can take over from here. So look, I'll talk to you briefly about some of the key elements to consider when structuring an EIIS investment. So first and foremost, you must establish an Irish limited company. Some companies are ineligible, and it's probably easier to talk about those rather than to talk about what is eligible. So examples being professional services, investment services, trading, forestry, coal mining. All of these are available online if you want to look them up, and it's easy then to rule out whether your company is eligible or not. It's important as well to know that investors will, in general, seek founder capital being committed as well. It's an important element to ensure alignment and ensure that the actual founders have skin in the game instead of simply taking risks with other people's money. The shares themselves and the investment should be used to fund growth. One important element is that a new employee must be employed during that 4-year term. The first E in EIIS stands for employment, so I guess you can assume that that's the case. So there are, as Kevin mentioned, a few different stages at which EIIS investment can be made. So at the pre-revenue stage, you can qualify for 50% tax relief. And once you're revenue generating, it can be 20 to 35%, depending on the stage of your company, but also depending on the plans with that funding. The holding period is a minimum of 4 years before you can redeem those shares, if it's a redeemable equity, or 4 years before there can be a qualifying acquisition or share sale. And the redemption itself or the share buyback can be funded from a combination of either an acquisition or a sale, free cash flow from within the business, accumulating from net profits, refinance from another funder, like a bank loan, or even fresh equity investment. When it comes down to claiming the tax relief as well, so there is an onus on the company to carry out some certain tasks. First of all, it's a self-certification as an EIS company. So you should check the revenue guidelines, but it's actually advisable to speak with a tax advisor if you're ever unsure, because the last thing you want is to believe you're a qualifying company, and then it turns out that you're not, and then there may be clawback either on you or on the investors, and then that tax relief is no longer valid. It's important to engage legal or financial advisors early in the process. You may not need a financial advisor to be specifically tied onto the raise if you do it so yourself, but you definitely need some solicitors to draft up contracts and agreements. Ensuring investors are unconnected is an important element too. There is another form of tax relief called SCI, reserved for family members, and there's also SURE, SURE, which is reserved for current employees paying PAYE who want to start their own business and have money that they want to invest themselves. They can then claim tax relief over the last 6 years. It's important to prepare a solid business plan, as this is vital when it comes to actually qualifying for EIIS. Once you've raised the funds, there are a few extra points that need to be carried out. So you need to submit what's called an RICT form of revenue. You get a statement of qualification outlining how much is available, how much tax relief is available to the investors. You give that to the investors. In the case of a fund, you just put in one line for the fund, and then the fund looks after the rest of it for you. There's some additional filings that the fund needs to do. You then maintain that EIIS status for 4 years. Otherwise, then there could be clawback, as I said, either on you, the company, or on the investors. Yeah, from the investors' perspective, once they've paid their taxes for the year, but if they're an employee, before they file their income tax returns, they can claim their tax relief directly through revenue or using their accountant.
Tim, that's just to your point there. Like for us as accountants, our clients would tend to come to us, I suppose, to claim the relief, as the investor. But your point there was interesting around the fact that the self-certification it's up there as the first point, but it's probably one of the most important points, that a company has to self-certify, kind of be ready to go before they go off attract an investment, whether it's redeemable or not. And like things that they have to have in place, like is there any basic stuff there that they have to have ready to be set, so they're good to go?
So, as I said, it's easier to rule out companies rather than to say that what to actually have in place. But to be honest with you, if you're an Irish limited company involved in a trade, the odds are that you should be qualifying once you are in business for, say, less than 7 years. So 7 years since your first commercial sale, or 10 years since you first incorporated. Those are kind of the main things to look out for. But then, as I said, it's important to sort of speak to your accountant or speak to an advisor, just in case there's any niche or side cases to be conscious of.
And Tom, there is like an interesting case we're doing at the moment. We're about to close an investment in an apart hotel in Dublin. So it's a lovely city centre location, derelict old building with planning permission to convert into an apart hotel. But you actually have to go. It's not just revenue needs to approve that, or you actually need to go to Board Falta and get approval from them that they will that you're considered a tourist traffic undertaking. Not many tax advisors, accountants, or anything know much about this, and to be honest, it's the first one we've done in maybe 10 years, so we're trying to get our heads around it. And I know the tax advisor on representing the company is trying to figure it out. And to be honest, I've talked to one or two EIIS specific tax advisors, and they haven't dealt with Board Falta before. So
that's interesting. Yeah, and that kind of falls into how the funds are used, isn't it? Because part of self-certification is that they're used, for, it could be like a relevant trading activity, or as you say, whether it's tourism or R&D, that kind of stuff, I suppose. But it's, I suppose, at the point you're mentioning, revenue can't necessarily sign off on that themselves. It has to be the Board Falta.
Yeah, and it's actually one of the scary things these days, especially for founders, is so the old system was you went to revenue, they certified whether you were qualifying or not, and at least once they had certified you, the risk was kind of off you that you qualified. But it was a horrible process. It took so long, and all the deals fell apart because revenue just took too long to approve stuff, or it cost too much money to get them to approve. We had one case where it took 4 years. The investment was done and finished by the time revenue actually approved it. Now it's self-certification, so technically you don't have to do anything. But at the same time, if you're dealing with
you're ready.
if you're dealing with a professional fund or someone like us, we're going to demand that you get a tax advisor to give you some advice, and you know what you're signing up to. Because if you tell us you're a qualifying company at 50% tax relief, and you're not, or you haven't bothered to get the advice on it, then you could be on the hook, or your company be on the tax relief if revenue come after it.
That's fair, yeah, that's fair. So there's a lot of onus on the company itself. You literally, you want to have your ducks in a row before you go there. But yeah, no, that's fair. So thanks for that.
Yeah, and even with I used to be a tax advisor. I've advised on this stuff before I was in the investment world, and like it's terrifying from a tax advisor perspective advising on this stuff. It's high risk, high reward, and you don't get paid enough for it. So there's not too many tax advisors who even want to take on this stuff or have the expertise
Yeah.
in it. It's really niche and quite awkward.
Okay.
Yeah, so I'll move along and just talk about the 4 different types of raising through EIIS. So in general, you could be what we call a loan ranger. So that's essentially you're going out there and raising money yourself for the company. You can engage a fundraising partner, so that'd be an accounting firm, a broker, or anyone else who might be able to support an EIIS fund. So as Kevin mentioned, there are currently 3 regulated funds or designated investment funds in Ireland, us, BVP, and AZETS. BDO and Davy had a joint venture in the past, but they have not done that this year. And finally, there's crowdfunding. So Spark Crowdfunding can do this. That's the Irish crowdfunding company, whereas you can go to a UK entity such as Cedars and Crowdcube. So with the Lone Ranger going out and raising yourself, in general, it'll be like a lot of it will be through people you know, to friends and family, posting it and publicizing it on LinkedIn. There's also Sunday Business Post does an EIS special, sort of first week in December, last week in November, where they put together every EIS investment in the country and put it all in one place so that investors can find the right investment for them. Best time in the year to do this is, well, organize it early, but to actually go out and raise capital towards the end of the year when people know how much tax they'll have to pay and how much they're looking to offset. In general, these sort of investments will be done through ordinary equity. It's just much easier, much more straightforward, and having redeemable equity will typically require more legal work and a fund manager to actually look after the investment. Now, there's no fees involved with this sort of raising, but there's obviously legal fees and advice that needs to be taken into consideration. But it's brilliant to actually get investment from people that you know. Some of the drawbacks then, I guess, it's difficult to raise. There's no one to review legal documents, and it's quite difficult to actually go outside your own network. So the Sunday Business Post is great, as I said, but there could be 20 other investments promoting themselves, and it's hard to really stand out from the crowd. If you engage a fundraising partner, it should make it much more straightforward, less stress, more likely to actually raise that investment. Like you'll set a goal in mind, and it's their job then to go out there and find investors. Some accountants and brokers do this, and they might have sort of one investment per year. Quintus, the accounting firm that we spun out of, would have done this for a few years when they weren't operating a fund, and they would have had, say, 1 to 2 investments per year, and specifically allocated towards their sort of high net worth clients. In general, you'll have to pay commissions to the fundraising partner, and there will be some DD involved in that. You'll also likely pay a monitoring fee to actually keep on top of it, especially when it comes to the redeemable equity, when there is that extra bit of legal work involved. The EIS funds, that's us. We've kind of talked through how we operate and what we do. But in general, yeah, we'll invest in redeemable equity only, but some of the other EIS funds might have an ordinary equity element. It's useful that you only have to deal with one fund manager, and it's guaranteed investment because we raise a fund at the end of every year, and then we deploy that capital the following year. So we raised in November and December 24, so just under 8 million. Then we had that sitting in a bank account in January, ready to invest. We don't have much of that left now, but there's money there. So if you're speaking to a fund, you know that it's going to be raised because they have capital that they're ready to deploy. In general, though, you likely pay higher commissions, and there will be that monitoring fee. But as I said, it's useful that it's already cleared off. Crowdfunding route, then it takes a lot more time and a lot more effort in general than the other options. You'll have to create a video, and also you'll have to promote yourself to the sort of mass market, to the wider public. Very useful for B2C companies, D2C companies who want to use this as part of their marketing strategy. yeah, quite a long route, and you will also need to raise equity investment from sort of a lead investor, an angel investor, or a fund in order to kickstart such a campaign. So yeah, not something to be taken lightly or as a sort of last resort. I'll talk through a quick sample case study. So as Kevin mentioned, we did invest into a creche. We actually invested twice. These figures are fictional, but I'll just talk through them kind of line by line anyway, so you have an idea of how it all operates. So taking an example of a creche where they're looking to purchase a freehold site. Total cost of the building plus fit out, 2.25 million. We'd be looking for roughly 10% of that minimum from the founders, so 250k founder capital, and then we'd put in €2 million from the EIIS fund. Now, over the 4-year term, there would be a placement fee or an arrangement fee, and there'd be an ongoing monitoring fee and an exit fee at the very end. So overall costs should add up to roughly about 280 to 300k, which would be paid throughout that term. And at the end of it all, there would be the investment amount plus a coupon paid out to the investors. So using the figure of 5% per annum, it would all be rolled up to the end. So 2.4 million would be paid back to the investors. This works out to be roughly 8 or 9% per annum, and the investors are getting a brilliant return because they also get to avail of tax relief. Now, in this example, I'm stating that this company will make about 400k of net profit, meaning that they can actually put aside money to redeem those investors after 4 years. There would be no interest, no mortgage, and no rent being paid during that term. So you'd imagine that the free cash flow, the net profit, would be much higher than it would be if there was a lease involved. After the 4 years, then you could be talking about a couple of different exit options, but in general, you would likely refinance through a bank loan or non-bank lender, or potentially even sell the business as part of a wider portfolio. And then that would be a useful way to get the investors back and then pocket whatever is left over at the end of it. But that all depends really on how long you want to stay in the business. This would all be sort of pre-revenue. So in general, you're not going to get a €2 million bank loan for a 2.25 million project when you've never made a commercial sale. That's just not going to happen. But if you've been in operation for sort of 3 or 4 years, you have management accounts to show profitability. It's much more straightforward to get that bank loan and do that over a longer term. At the end of the day, you'll still own the building, so it makes it quite attractive.
Yeah, and I think that's the point. Like it's those certainly the earlier stages, and that's what EIIS is targeted at anyway, Tim. The earlier stage businesses where, like we know from our own clients, when they're at that, those the first delicate few years, it's very difficult. It's very difficult to get back in from the bank for obvious reasons. So like your case study there, makes sense from that point of view. Do you find that companies would because you mentioned exit, and I'm just thinking, could it be used then as part of an exit strategy overall for a business? Like they might take the investment for the 4 years and decide, okay, we either refinance at the end of the 4 years or we get out. I suppose it might just depend on the circumstances at that stage.
Yeah, it would definitely depend on the circumstances and how they see the business operating over the coming years. So if they see themselves having an opportunity to get out after 4 years and they don't want to run the business anymore, or they want to shave off a part of the business and focus on something else, they can do so. But in general, people will use this as a means to get to the 4-year period, and then they can take on and continue to grow without having to worry about repaying this EIIS investment or redeeming those shares. It's all down to some circumstances at the end of the day. But with these sorts of projects, with the real estate angle, there's a very clear exit strategy for the investors, which makes them much more comfortable too. So it kind of makes the working relationship a little bit easier.
Okay, thank you.
So yeah, moving on to the final slide. Essentially, this is just a summary. The slides can be sent around afterwards anyway. But checklist for EIS funding, because it's important for you to, as we mentioned, check that you qualify for EIS, do the self-certification, but speak to someone who knows to ensure that ensure that you don't find yourself either repaying tax relief or your investors doing so. Prepare your financial model and a pitch deck, get some advice in legal structuring, and get out there and meet investors, whether it's individual investors who want to take part in the fundraising, or one of the funds that's out there, and define that exit plan as well, because investors want to know how you imagine this to transpire over the 4-year term. Do you see it being exited through a bank loan, or is there another option out there? And finally, what we look for, so as I said, we look for a minimum of 10% from the founders. We look for a financial model with clear cash flow, and we look for that exit strategy along with a business plan. So a business plan is actually vital and essential for any EIS investment, because this is part of how you show revenue that you should be EIS eligible, and that the investors should be entitled to that tax relief. Unless you have anything else to add, Kevin, we can open it up to the floor for questions, or to Tom and Joanne to field them.
Tim, I'm just something that kind of mulling in the back of my mind there. EIS for EIS relief to happen, like I suppose we're looking at you know, the whole qualification criteria. I'm looking at the investor. Is there a rule where they have to keep their shareholding below 30% in a business, or something around that area anyway?
Yeah, like you shouldn't have control in the business.
Yeah.
Yes, so it should be below control levels. I think there might be a 25% limit on it for an investor. There is some limit in there, right? Like that's why we'd have redeemable shares that don't really have voting rights. Even if we were putting in the majority of the capital, we wouldn't have the majority of the voting rights.
Okay, yes, you can structure it. You can structure the legals, and actually, that was something I was thinking of as well, because during the webinar we talked about the importance of the legals and the tax compliance in the process as well. So you just mentioned there, Kevin, like a really important part, like, is make sure, you know, the right legal people are over this, and making sure that the I's are dotted and the T's are crossed almost as well on the legal and tax side.
Yeah, like we're going through with a company now at the moment that we've invested in, who are going to the UK to raise EIS, their version of it, and you know, it's a little bit of a different system there. You need pre-approval. So like we invested in a company a few years ago, but like the UK tax authorities now are like going through all our legal documents to make sure we don't affect any of their rules, and that kind of, by like stuff that we might have in there, that if something was breached, that we could control the business, or something that you can't actually do for UK EIS and that kind of stuff. So yeah, it's a complicated enough world, but like at the end of the day, like I think founders just need to keep it a bit simple and easy, and that like if you're a new business and it's the first time you've done this, you likely qualify for EIS. If you've traded, you're probably in the 35% bracket. And then if you're going fundraising and you're not dealing with a fund, you're just dealing with like high net worths and HBAN or Angel Network, just give them ordinary equity. It's very easy. It's very straightforward. They kind of get a 35% discount on the valuation they're offering them, and it reduces their risk going in. Like everyone loves to kind of talk about the complexities in EIS, but like it's there for a reason. Investors love it. It's good for the ecosystem. And it can be quite straightforward if people keep it straightforward.
And do you find like that there's good uptake in the whole EIS piece? You mentioned like it's relatively it can be relatively straightforward if you kind of approach it that way, or have the right people, you know, involved.
Yeah, like I mean, look, the way we structure it is quite complicated, and it's a tried and tested way of doing things. And if you're dealing with also one of the regulated funds, you're going to need a very good solicitor on your side, and someone who knows what they're doing. So yeah, and that's why like our investments will kind of start at 1 million plus. It's not worth our while doing smaller investments, because it's overly complicated. And I think where companies run into trouble is they try to replicate our structure, but they do it themselves. because they hear this is the way EIS works, but it shouldn't be if you're doing it yourself as a company. You should just be issuing ordinary shares to people, giving them
Yeah.
the 35% tax relief, saying you qualify for it. And then it's relatively straightforward and easy. There's no need for complicated legal agreements, big tax opinions, anything like this. It can be straightforward, but I think people misinterpret it how it should be structured.
Okay. Yeah, that's fair enough. Um, yeah, and you mentioned earlier then that you would see like the kind of businesses that would be taken up the IAS certainly with Quintus would be like the solar farms, the wind farms, the childcare, that kind of thing. Do you find that they're the main sectors that are currently attracting the attention, or is there other sectors as well?
They're the ones at the moment because
Mm,
the tax relief's the best there.
okay.
50% tax relief, if you can do it pre-trading, and we just wouldn't
Mm,
invest trading in something that's higher risk, like it's in R&D phase or hasn't made a commercial sale. But like look, over tax rules change all the time. When everything was 40%, we invested in a lot of trading businesses. Plenty well-known ones. We've invested in Squid Loyalty, Vado Coffee, All Real Nutrition, Ground Wellbeing. They're manufacturing businesses, they're food businesses, product businesses, technology. We invested in Gigable. So yeah, there's plenty of other ones in our portfolio that we've invested in. We have about 10 like traditional scaling trading businesses in our portfolio. Um, we're not looking at them at the moment. But yeah, like there are options there for those kind of companies too.
yeah. Yeah. So yeah, that's good to know. Joanna, I'll hand over to you in a sec, just in case there's
Yeah,
questions coming through.
yeah.
Um, I suppose the final one for me for the moment is there anything that whether it's a financial factor or operational factor that might make a company more attractive for investors over another, for example? Maybe it is the fact that they've got a track record or something like that, but something that yeah, that just makes it much easier.
Yeah, like the track record is an interesting one. Because like, look, I'm a business owner. I'm a first time business owner, and there's a lot of learning curves in a first time business owner. People who've been there and done that and understand how to structure businesses, understand the importance of financials and having good accountants and CFOs and financial controllers and structures. They're a lot more attractive to people to invest their cash because they've been there, they've done it, they know what a company looks like.
Yeah,
So that is very, very important. Like we've recently invested in a business, and then the founders are very, very experienced. One of them was a finance director and founder of a very well-known healthcare business. And they're just experienced to know what they're doing. And look, that's no one's fault that it's your first time business, but it's higher risk for someone if you're kind of holding their hands and teaching them along the way.
yeah,
That is certainly something we look for. If we're going into something very early stage, we need to see the founders putting in their own money, friends and family money, whatever it is. It's very rare someone's just going to come and fund your business if you're not willing to do it. Main reason is it just shows that you are committed to this business and
yeah,
you're not going to run away at the first sign of a bit of animosity. Um, yeah, look, if you're a scaling business, love seeing profits.
Mhm.
Don't love seeing a business that just wants to keep burning money,
yeah,
spending, I even hate the term burning money. I just think it's a horrible thing when you're raising
yeah,
other people's money and then talking about burning it. To go chase growth. And we certainly prefer steady, profitable, growing businesses. If you want high growth scale, you need to go to a VC firm or angel investors who are prepared to take that risk and take the failures that come with the wins.
yeah. So skin in the game is what jumped to mind when you're talking about investing some of your own money. And you're there for the long haul. And financial stability. It could be having the support within the business, where you said the CFO, and having all those structures in place, and they know what a company looks like, but also the numbers are stable as well. So that you could look at it, and it's probably a picture that's painted as opposed to one specific thing as well, Kevin.
Yeah, and look,
Yeah,
yeah, we deal with a lot of the other investment firms in Ireland and finance providers and stuff. And like there's so many firms who won't touch you unless you have proper financial structures in your business. And there's too many business owners who think a finance function is something they can't afford. And I find it amazing to think how can you operate a business without having a proper finance function, whether it's a good quality outsourced function or people in-house to mix with an outsourced function. But it's just so important to any business to know exactly what's going on in the numbers all the time.
Yeah, that's fair. That's fair. No, thanks for that. Joanne, I'll jump over to you then.
Yeah, we have a question here. Are there any red flags that might put investors off when reviewing an EIIS opportunity?
I don't know, can you think of anything, Tim, off the top of your head?
Well, I guess it's the opposite of the question before, which is if you're not putting money in yourself, if you're not an experienced founder and you're brand new to it, or you don't have the building blocks in place yourself already. So, like when you're making your pitch deck, when you're making your business plan, I mean, having it clearly laid out, like your plans for growth, how you're going to get there, your go-to-market strategy, whatever it happens to be, and why you're the right person for the job. I mean, those are the things to look out for. And those are the green flags. So I guess making sure
Yeah.
to not be on the wrong side of those is some pitfalls to avoid.
Yeah.
And I think just with the question alone, you know, to an EIS investor, EIS investors are all very different.
Yeah.
If you're getting a capped redeemable share, you want something safe and boring because you're not, if something becomes a unicorn, you don't share in that upside. If you want an ordinary equity and you're investing looking for unicorns, that's a total different risk profile and type of investor. So like EIS is just the name of a tax relief, but it really depends on how you structure it underneath it to what's going to be a red flag or what's important to that investor.
Yeah, no, that makes sense. And from an investor's point of view, what makes an EIIS opportunity stand out?
For us anyway, like I can only, I suppose, speak to ourselves instead of all the angel investors in the country. We're looking at social infrastructure projects. If anyone's looking at constructing a profitable trading business, if there's a warehouse involved, there's a creche involved, a healthcare facility, a sports facility, we're very interested in that space because we're comfortable with it. We have a real estate team, and it's what we like.
Yeah. Perfect. There's no further questions there. If there's anything else, either or any of you would like to add before we finish up for this morning's session? No? So we will thank you everyone for joining this morning and for your participation, and of course to our guests, Kevin and Tim. It was very informative, and for you, Tom, as well, to join to facilitate the discussion. We will share the copy of the slides and the recording as a follow-up from the webinar, but do reach out if you have any further questions around the scheme or want to hear more about Quintus. We'll put you in touch with the guys. So thanks so much, everyone, and have a great day.
Perfect.
Thank you
Thanks
all.
so much.
Thanks so much. Bye-bye now.
Bye. Bye.
Bye.